Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a fairly new topic for those of you that are relatively new to options trading. This webinar is really designed for those of you that are in the learning process for trading options, whether you're brand new to options trading or if you've already gone through some education, maybe you've already placed some of your first trades. This is really designed to give you a better understanding, number one, of the basic fundamentals of options trading, but also one of the reasons that I like to do this webinar is because for many investors that are going through the learning process of how to trade options, it's a process that typically takes many times 3 to 6 months for most beginners to really get to the point where they're comfortable enough to trade options. And throughout that 3 to 6 months, many times I see investors struggle with the education, feeling that they're not quite getting it, and a lot of terminology that they don't understand. So what we do is we want to make sure that we take the time to address the fact that options trading is complicated, and what we want to do is we want to give you a bit of a jump start, meaning what we want to do is we want to show you, if you take the time to learn how to trade options, what do you get at the end of that? What can you expect for your portfolio if you did take the time to learn how to trade options? So today what I'm going to do is I'm going to jump forward, pretend for a second that we all know how to trade options, that everyone here is sophisticated and knows exactly how to utilize these strategies, and show you what benefits they provide for your portfolio. And then once we understand that, you can decide for yourself, is this a type of option, is this an asset class that you want to learn more about? And then what we'll do is we'll pull this back and get to some of the basics and show you the fundamentals of buying calls and puts. Now, the reason that I want to do this, and especially even if those of you that are experienced in options trading, I find that this is such an important webinar because it really comes down to the fundamental building blocks of options trading that you need to really understand in order for you to progress into trading even simple strategies, and then more so on more complex strategies. For those of you that have the fundamentals down, you will find that no matter how complicated options get, you'll be able to break it down and make sense of it. But if you don't really understand the fundamentals and you jumpstart into some of the more advanced strategies, trading spreads, condors, butterflies, straddles, implied volatility, these types of terms that you might have heard of, they will be more and more confusing if you don't first understand the fundamentals. So even for those of you that have experience trading, even if you've been trading for a while, please take the time, take a step back and make sure that you do review the fundamentals. Make sure that you understand what a call is, what a put is, the difference between buying a call and selling a call. Because once you understand those things, all the world of options is open to you and you can utilize them for your portfolio. So let's go ahead and get started. Before I do, what we're going to discuss here today is for demonstration and education purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, what I'm going to do is, like I said, I'm going to jump ahead first, and I'm going to show you why you should trade options in terms of what are the ways you can utilize options for your portfolio. This is, again, assuming that you already understand the option strategies, you already understand how options work. And so what we're going to do is we're going to cover first income generation, because first and foremost, the strategies that you're going to be approved to trade, the strategies that you're going to want to deploy for your portfolio is predominantly going to be really has nothing to do with options. It really has to do with your stock investments or your stock portfolio. So we'll talk about how you can utilize options to generate income for your stock portfolio. This is the best way to get started with options trading, because what you're working with is something that you're already familiar with. You're familiar with buying stocks that you want to purchase and then selling those stocks hopefully at a profit. That's something that any equity investor is familiar with. And what we want to do is we want to show you how options can be utilized to help you buy stocks at a lower price and then sell stocks at a higher price. So really just helping you enhance your stock positions. Then we'll talk about speculation. This is usually the part that brings many investors to looking at options, is how can I speculate on the markets? I have a stock that I think is going to go higher, or I have a stock that I think is going to go lower. How can I take that view and express that utilizing options? So we're going to talk a little bit about speculation. And lastly, something that you don't use very often, but comes in very handy when when the time arises, which is hedging a market correction. So during the February sell-off through the middle of March, we had a very fast, violent, and severe sell-off. Could you have possibly hedged some of that risk with an option contract? Those are the things that we're going to explore here as well. And then once we understand the three primary use cases of options, then we'll take a look at call and put contracts. So the difference between what a call is and a put is, so that you understand them, because those are the fundamental building blocks. Once you understand them, all other option strategies will make a lot more sense. And at the end, we'll try to go through some questions and some examples and answer any questions that you guys have. So my name's, the question that I predominantly want to help investors answer here today is, what are the ways that options can be utilized for your portfolio? And I want you to be able to leave this session here today having a good understanding that even if you're not comfortable yet deploying options for your portfolio, just understanding how you can utilize it, in my opinion, many times is the motivation that you need to continue your options education journey. Because like I said, that options education journey many times can be frustrating at times. So many times we need a little motivation to see what's on the other side. What do I get if I spend that time to learn? And hopefully that's what we're going to show you here today. So my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. What I'll be doing is I'll be breaking down how I learned how to trade options to hopefully give you a better understanding as to how you can deploy this for your portfolio. Now, before I get started, if everyone could please bring up your chat window, which is at the bottom of your screen. There are two buttons. There's a Q&A button and a chat window. Please bring up that chat window. And I just want to get a sense for the audience here. How many of you are in the process of learning how to trade options? Please type yes into the chat window if you are learning how to trade options. And please type no if you are a fairly experienced options trader. Okay, I see a lot of yeses, quite a few no's, but a lot of yeses. So great. And a lot of you say 3 months experience, 5 months experience, so many replies, great. And for those of you that replied no, again, keep in mind that the goal here is to help you recap the fundamentals. Many times I tend to find that many even experienced investors, don't really understand the fundamentals really well. And what that does is it really hinders your ability to trade more complex strategies. Once you get outside of your comfort zone or strategies that you've been taught, it becomes difficult to really understand them. But if you can understand the fundamental building blocks, any type of strategy I throw at you, you'll be able to understand. That's how I'm able to, I get tons of emails from people sending me all types of crazy strategies and saying, what do you think? The only way I'm able to make sense of all of it is by truly understanding the fundamental building blocks. So let's go ahead and get started. So we're going to want to first answer the question, why should you even trade options? Why do you want to look at options as an asset class? And this really all comes down to participating in the markets. Like I said, what I tend to find is that despite the fact that the majority of options users utilize it to generate income, most investors first learn about options because they learn that options provide leverage, and they do so in a way with limited risk. That's the most, I would say, attractive piece of options, because who doesn't want to speculate with leverage? Because we all know leverage is a double-edged sword, right? It can work in your favor if you get the direction correct, but it can really hurt your portfolio if you get the direction wrong. But options give you leverage, but limited risk, so that if you get it wrong, there's only a limit as far as how much you can lose. But if you get it right, you can really knock it out of the park. That what we call asymmetrical risk reward ratio is what I find most investors, is what attracts most investors at first to options. But if you look at actual trading volumes, what do people trade more when it comes to options? The vast majority is actually for income generation. This is for your stock portfolio to generate income on it. And more importantly, and lastly, once a user is fully comfortable with options, once they understand the fundamental building blocks, once they have traded some more advanced strategies, and they really start to put and play around with them, this is really where options become a tool for professional investors or experienced options investors, which is creating customized payoffs, which means that today I think the stock's going to go up, tomorrow I think it's going to go down, tomorrow I think it's going to go up, and the further I'm going to go down. How do I make money off of that particular graph? You can utilize options to do it. And once you understand the fundamental building blocks, you'll be able to create a custom payoff graph for whatever outlook you have on the underlying stock. Even if you think the stock's just going to stay where it is and not move, you can sell option strategies to be able to take profit from that. But when I think of options trading as an asset class and why I use it so much for my portfolio is predominantly for risk mitigation, to protect my portfolio and protect my profits. Now, this is really where it comes down to a bit of a shift in terms of how you think about your portfolio and how you think about options as a tool, because options is really just a tool to help you navigate the markets. And I see options as a way to help me navigate the markets with limited risk. And so those are some of the things we're going to learn here today. But first off, like I said, the predominant use of options when you look at trading volume is going to be in income generation. So these are strategies that allow you to add yield to your stock or ETF portfolio. So for any of you, and please type 1 into the chat window if you are a equity investor. If you invest in stocks or ETFs, please type 1 into the chat window. So I see a lot of ones coming across the screen. So many times, if you're a stock investor, how do you buy your stocks? You place a limit order or a market order that allows you to buy your stock at a price that you want. And then how do you sell your stocks? You also sell your stocks with a limit order or a market order that allows you to sell your stocks at a price level that you want. So how can options help you then? Options allow you to buy and sell your securities at a lower price than what you normally would place a limit order for, and allows you to sell your stocks at a higher price than what you would place your limit order for. So what that does is it gives you a discount on the purchase and gives you a bit of a premium on the sale. So if you're able to buy every single stock that you buy with a bit of a discount, it's not a huge discount, but it is a discount. And then if you're able to sell your stocks at a premium than what the market is currently paying you, what does that do for your portfolio? It enhances your portfolio and it generates an income stream. This is predominantly what most equity investors utilize options for. So there are 3 possible strategies that you would use. The first one is selling a cover call. Whoops. Selling a cover call. This is the first strategy that you'll be able to trade. And what this allows you to do is sell a stock that you already own at a price at higher than the current price, but do so at a premium above that current price. So it generates an income stream for your portfolio. And you can only do this on stocks that you already own. And this is the only strategy that doesn't add additional risk to your portfolio because you already own the stock. And the only thing it does is it reduces the risk of the stock portfolio or the stock holding that you have. The income stream that you generate on the cover call generates income for your portfolio, so it actually reduces risk. It's the only strategy in options that doesn't add any risk to your portfolio, actually reduces it. The second strategy you're going to learn as a trader, which I think is by far the most underutilized strategy by options investors, is selling a cash secured put. Because cash secured puts allow you to buy the stocks and ETFs that you want to purchase at a discount. And many investors see this as a risky strategy. But I think that investors who think that are comparing it to the wrong strategy. If you compare selling a cash secured put to placing a limit or market order to buy your stock, the two are designed to give you the same thing, which is allow you to purchase the stock at a specific price. Now, when you place a limit order, that's the price you're going to get. When you sell a cash secured put, you're going to get your limit order price plus a discount. That discount factor many times could be roughly 1 to 2% of the underlying stock price. So imagine if you can purchase every single stock or ETF in your portfolio with a 1% discount. It's not a night or day. It's not going to make or break your portfolio, but 1% discount on every single stock purchase is going to go a bit towards your overall return. So this is something that you want to consider to start taking a look at. If you're an options trader and you're a stock investor, how can you buy your stocks at a small discount using cash secured puts? And lastly, for more advanced traders, selling a credit spread. This allows you to generate income on a portfolio without owning the stock or wanting to own the stock. This is a more advanced strategy. This is the one that we utilize very heavily in some of our daily plays. For those of you that have followed us over the past few weeks, we've sold many credit spreads. So these are the types of strategies that allow you to generate income in any market environment on any stock, even if you don't want to own it or wish to or want to own that particular stock. So those are the three ways that you generally could use options to generate income. But like I said, what's most attractive about the options strategies are the ability to trade with limited risk and limited capital. So I would say a lot of investors with smaller accounts tend to gravitate towards options because they learn that they can control a similar size trade with a smaller amount of capital or utilizing leverage. Now, every option contract controls 100 shares of the stock at a fraction of the capital that it would typically require to buy 100 shares of the stock. And most attractive of all, it's a limited risk strategy. So you think to yourself, yes, I can control 100 shares of stock with just 5% of the underlying stock price. Why wouldn't I do that, especially if I have limited risk? There are some trade-offs with that. So today what we're going to do is we're going to explore what those trade-offs are when you're able to control a relatively large amount of capital with a small amount of capital and you have limited risk. So the two strategies that you're going to learn at first is buying a call option, which is when you have a bullish view on a stock, and then buying a put option, which is if you have a bearish view on a stock. Those are the two strategies we're going to go over here today. Make sure that you fully understand those two strategies before you move on to any other education. It's so important that you understand these two strategies and the nuances of this strategy, because technically, to call a bullish strategy, a call option a bullish strategy is not 100% correct, and to call a put option a bearish strategy is not 100% correct. And I want to show you what I mean by that here today, so that you have a true understanding as to what buying a call and buying a put really means, so that you can determine, should I buy a call option on a stock that I think is going to go higher, or should I buy a put option on a stock that I think is going to move lower? And then once you learn those basic strategies, what you get is actually slight improvements of that strategy. So we can now combine buying calls and selling calls together to get even better risk-adjusted returns for our portfolios. And that's when we start getting into vertical spreads. So these are the more intermediate strategies. This combines buying a call option and selling a call option in a single strategy that actually gives us even more leverage with less risk. So a lot of times, well, that's all we want, right? We want better returns with less risk. How can we achieve that? We can use that when we use a combination of options in conjunction with each other. And then what we can do is we can also sell credit spreads. This is the more advanced strategy. This is really selling calls and puts and how we can improve those. And I'm not going to get into that right now because that's just jumping a little too far ahead. But this is the more advanced strategy that allows you to generate income when you have a slightly bullish or bearish view on an underlying stock. So that's a little bit ahead. Once we learn more about the difference between buying versus selling options, then we can start getting into some of the education about debit versus credit spreads. And then lastly, hedging a market downturn. So February 19th, market peaked 2020, and we had about a 35% decline in the markets from February 19th down to March 23rd. This is by far one of the most severe sell-offs we have ever seen in the market in history, at least in recent past. So the question is, could you have protected yourself using options, or at least could you have utilized options to give you a sense for predicting when these types of sell-offs were going to happen? These are some of the things that if you join us here on our Tuesday and Friday morning market outlook sessions, we look at many of the indicators that are derived from options data that give us an indication as to whether or not markets are about to sell off. A lot of investors felt that the markets were about to sell off a couple of weeks ago. And we looked at those market indicators and we said, not yet, because the options market were not implying a stress market or a market that was at a point where they were about to sell off. So it's important to look at options, not just from a protection perspective, but also the indicators that they provide that give us some clues into whether or not we're heading into a market downturn. And if we do see that those indicators are firing off, then we can utilize options to protect our portfolio. So one of the things that we learn about here at OptionsPlay is how do you protect your portfolio against a market downturn? How do you protect your portfolio on an equity investment that you own? So let's say you own Apple stock and you're concerned that it's going to fall in value. How can you protect that investment? You can buy some puts. That is a beginner strategy. And then you can buy some put spreads, which is a more advanced strategy. So those are some of the ways that you might be deploying options in your portfolio after you go through the learning process of these types of strategies. So with that, what I'm going to do is I'm going to jump into probably the slide that I hate the most, the terminology that I hate the most, because what I'm about to describe to you sounds like I'm reading to you a legal contract. And the reason for that is because I am reading to you a legal contract, because an option is a contract. It's a contract between two parties. And what does that contract specify? An option contract provides the buyer of the option the right to, but not the obligation to buy in the case of a call option, or sell in the case of a put option of an underlying stock or ETF at a specified price, or what we call the strike price, on or before a specific date, or what we call the expiration date. Now, if this was the first time you've heard that and that sounded like a mouthful and you had no idea what I said, that is completely normal, because this is a mouthful. It's difficult to understand. So that's why today I want to break down exactly an option contract so that you can understand what it means to buy an option contract, what it means to sell an option contract, what is a call option, what is a put option, what is a strike price, what is an expiration date, what do these things mean, and why do you care about these things when you're trading an option contract? And you always remember, the one thing that I think is always important to remember when it comes to these option contracts is that the buyer of an option is the person who has to pay to get into the contract. The person who sells it is the person who receives that premium that the buyer is paying for. And we call the amount that a buyer pays the premium. So we call it the premium. That is the amount that the buyer is paying for that option. And the premium is what the seller is collecting when they sell that option. And whenever we have an option, it's always the buyer that has the power. The buyer is the person who has the right, but he doesn't have the obligation to exercise. The seller always has the obligation. If the buyer wants to exercise the option, the seller has to fulfill those demands. So those are the key things to remember. Now, like I said, this is a mouthful. This is a legal contract. The best way to really understand it is to go through some real examples. So like we said, there are call and put contracts, there are buyers, and there are sellers. So the best thing to remember is that because you can buy and sell a call or a put, you know that there are 4 possible strategies. Now, what I'm going to do is I'm going to break down these 4 strategies, and I'm going to go through some examples. So when we have a long call, long put, short call, and short put, this can be confusing for most beginners. And the best way to remember this, in my opinion, is to think of buying and call options as positive actions, and think of sells and puts as negative actions. So we know a sell is a negative, a put is a negative. So to remember which strategy you're actually trading, you just have to do basic multiplication, because if we're buying a call option, that's a positive and a positive, that becomes a bullish strategy. If you're buying a put option, that's a positive and a negative, that's how we know that's a bearish strategy. If we're selling a call option, that's again a negative and a positive, so that's a bearish strategy. And then if we're selling a put option, that's a negative and a negative, that's a bullish strategy. So that's a trick that for those of you that are new to options trading and you're confused a little bit about buying and selling calls and puts, that's one easy way to remember which strategy is which and whether it's a bullish or bearish strategy. You want to make sure that you at least understand what directional view each strategy actually has. Now, whenever you buy a call option, what that means is that the buyer of the call option has the right to buy a stock or ETF on or before an expiration date, a specific date. So an option contract will have will tell you what stock or ETF it's for. So let's say this is for SPY. So if you buy a call option on SPY, it will also tell you a specific expiration date, so maybe September 18th. and we'll get into that as far as why September 18th is an expiration date, and then add a specific price. So let's say it's 3:30. So when you buy a call option, you're going to have these specifications on your contract that says the buyer of the call has a right to purchase SPY on or before September 18th at $330. And the person who sells this contract to the buyer has the obligation to sell SPY on or before September 18th at $330 to the buyer. Now, the buyer is the person who decides, do I want to exercise this option or not? And we're going to explain to you why someone would exercise and why they wouldn't exercise at expiration, depending on where SPY is trading on expiration. And the best way to do this, again, I think the best way to learn is to go through some examples. So what I'm going to do is I'm going to have we have four possibilities. You can buy a call, sell a call, buy a put, sell a put. We're going to go through each one. We're going to go through an example here. And I'm going to use stock XYZ. So this is a fictitious stock, XYZ. It's currently trading at $100. So the stock is trading at $100. So what I'm going to look at first is buying a call option. So let's say I buy a stock XYZ's call option, a 100 strike call option for $3, meaning this call option currently costs $3. And I want to walk you through this example so that you can see, well, why would I ever buy a call option on stock XYZ for $3? So remember, when you buy a call option, you have the right to buy that stock on the expiration date, on or before the expiration date, at the price, the strike price in this particular case, which is $100. But I paid $3 for the right to exercise that option. So what I'm going to do is I'm going to give you a bunch of examples. And once we go through a few different scenarios, this will make a lot more sense to you. So let's say I'm a buyer of this XYZ stocks, a $100 call option, and I pay $3 for it. So let's say on expiration date. So I buy this option today, and let's say the expiration date here is September 18th. So let's say so I buy this call option today for $3, and on September 18th, the stock XYZ, it doesn't move higher, it doesn't move lower, it's just still trading at $100 roughly one and a half months from today. So September 18th right now is about 43 days away. So let's say 43 days goes by, and the stock is just trading at $100. It hasn't moved. So what happens to the call option that I purchased? So I have the right to buy the stock at $100 on September 18th, and I paid $3 for it. So if I have the right to buy a stock that's at $100 and the stock is trading at $100, what that means is that my call option isn't really worth very much, because I can exercise this call option, buy it for $100, but anyone can buy the stock at $100 on the open market, because that's what the stock is trading for. So what that means is that as the call buyer, what is my end result for this particular trade? The answer is, and if anyone has the answer, you can type it into the chat window. What happens to my trade if the stock is at $100 on September 18th when I bought the call option for $3? So Nick and Arnaud, quite a few people answered correctly, -$3. So what that means is that I've ended up with a loss of $3. Why is that? Because if I bought an option for $100 and I can exercise it for $100, but I paid $3 to get into the trade, then my net here is that I've lost $3. And when I go through a few more examples, this will start to make more sense. Let's say instead the stock, instead of being at $100, declines to, let's say, 95. Let's say I bought this $100 call option. The stock, instead of going higher, moves lower. It moves down to 95. So I have the right to buy a stock at $100 that's currently trading at 95. Now, why would I pay $100 for a stock that I can buy on the open market for $95? The answer is I wouldn't. So what that means is that it would not make sense for me to exercise my call option. My call option is worthless. So my net result when the stock is down at $95 is I've also lost $3. Now, this is true for any price below $100. If the stock's at 98, if the stock is at 90, or even if the stock is at 0, my call option is worth -$3. So no matter what price below $100, I've lost $3. So if I buy a call option and the stock, instead of going higher, just moves lower, I've lost my $3. Now, let's say on the flip side, the stock does go in the direction I expect it to, right? Buying a call option we know is bullish. So let's say the stock rises to, let's say, 103. So now I have the option to buy the stock at $100 when the stock is currently trading at 103. So that means if I can buy it from the seller for 100 and immediately sell it on the open market for 103, what's my profit on that trade? It's going to be $3. But remember, I paid $3 to get into that trade. So my net on that trade is actually 0. So if the stock goes from 100 to 103, what happens is I basically is what we call break even, because the movement in the underlying stock or the profit that I made from the call option offsets what I paid for that call option. So my net at 103 is basically 0. Now, let's say instead at 103, let's say the stock rises to 105. So now I have the right to buy the stock at $100, but I can immediately sell it on the open market for 105. That's a net profit of $5 minus the $3 that I paid to get into the contract. So at 105, what happens is I've made $2. So here I lost $3, here I've made $2. Now, what you're going to see is that as the stock continues to rise, guess what? I make more and more money because I can always buy the stock. I have the right to buy the stock at $100. And if the stock trades at 110, then I can sell it for 110, realize a $10 profit minus the $3 I collected on the trade. So if the stock's at 110, guess what? I've now made roughly $7. And what you're going to see is the further the stock goes higher, the more money I make. And what you're going to see is that you're going to see a chart that looks something like this. And for those of you that have learned how to trade options, you probably have seen a chart that looks similar to that, where you have kind of like a hockey stick graph. And this is really how that hockey stick graph is created, because when you buy a call option, the more the stock goes in your favor, the more money you can make. The more the stock goes against you, you're limited to what you've lost or what you paid for that call option, which is $3. So what that means here is that when should you buy a call option? And the answer is it depends on how much the call option costs, because in this particular case, this call option costs $3. So when does it make sense for me to buy a call option? It only makes sense if I think this stock is going to go to 103 or more. So if I think it's going to go to 104, 105, 106, and remember, there's an expiration date. So I have to believe that it's going to make that move before the expiration date in order for it to make sense for me to buy this call option. So that's the challenge here, because normally when you buy a stock, if you buy stock XYZ and the stock goes up even by a penny, you start making money. Here, you don't make money if it goes up by a penny. It only makes money if it goes up by the $3 that you paid. So what that means is that even if you think it's going to go to 103, it doesn't make sense to buy a call option, because guess what? At 103, you don't make any money. You're just breaking even. You need the stock to go to 104, 105, 106, 107, 108, somewhere higher than 103 in order for it to make sense for you to buy that call option. And that is the first, I would say, difficult thing to learn for most options traders, is understanding when should you buy a call option, because many investors, they learn, oh, call option is bullish. I think the stock's going to go higher. Let me buy that call option, without really truly understanding when does it make sense to buy that call option. And this is just one, and one thing that I really want to point out here is, let's say this call option didn't cost me $3. Let's say it cost me $5. Now, how far do I think the stock needs to go before it makes sense for me to buy this call option? If anyone has the answer, please type it into the chat window. And many people have this correct. Bill, Kate, Maura all say over 105. So what you realize here is that when you're buying a call option on a stock, not only do you have to be bullish on the stock, you also have to look at how much does the call option cost, because that's how much you need to figure that the stock needs to move before it makes sense for you to buy that stock. And that, again, is probably the most counterintuitive part about trading options, and the most important lesson to learn when you're thinking about buying a call and buying a put option. So next, what we're going to do is we're going to look at, well, what happens if I bought a put option, a same $100 put option, and let's say this put option costs $3. So I'm just going to do the same example, and I think you're going to see that the trend here is relatively similar. So what you're going to see here is that if, let's say, I buy a $100 put option, which gives me the right to sell, whoops, if I buy a $100 put option for $3, it gives me the right to sell the stock at that specific price on or before the expiration date. So let's say, again, the expiration date here is September 18th. So today is the 6th of August. Between now and September 18th, I have the right to sell this stock at $100 to the seller of the put option, and I paid $3 for that right. So let's say a month from today, or on September 18th, the stock is still trading at $100. How much is my put option worth? If anyone has the answer, please type them into the chat window, but I would imagine many of you will have the correct answer. And the answer is -$3. Why do I have -$3? Because I paid $3 for something that is effectively worthless to me, because I have the right to sell the stock at $100 when I can just buy it on the open market for $100 and sell it to you for $100. I make no money on that transaction. But remember, I paid $3 for this right. So the transaction is worthless to me, but because I laid out $3 to get into the trade, I'm down $3. Now, this statement is true for any price above $100, because this gives me the right to sell something for $100 that I can buy on the open market for a higher price. I would never want to buy something for, let's say, $105 and then sell it to you for $100. I would lose $5 on that transaction. That doesn't make sense for me to do that transaction. So for any price above $100, guess what? I've basically lost the $3 that I paid for that put. So that's why when you look at a put option, and once you buy a put option, if the stock continues to rise, what you paid for that put option is what you lose, no matter what happens. Even if the stock goes to 1,000, you're only risking $3. You're only losing $3. But if, let's say, the trade does go in my favor, the stock does decline in value. Let's say that the stock declines $3, it goes down to 97. How much is the put option worth to me? It's worth 0, because what happens is now I can sell the stock to someone for $100 that I can buy on the open market for 97. So if I can buy something for 97 and immediately sell it to the seller of this put for $100, I realize a $3 profit. But remember, I paid $3 to get into the contract, so the two net themselves out to 0. So at $97, I make 0. So let's say the stock goes down to 95. So what happens at 95? Now I can sell the stock to the seller for $100 that I can outright buy for 95. So if I can buy the stock for 95 and immediately sell it to you for 100, that's a $5 profit that I made. But minus the $3 I paid, that means I make $2 on that transaction. And the further the stock goes lower, the more I make on this put option, because I can buy it at a lower and lower price and continue to sell it to someone for $100. The further the stock goes lower, the bigger the profits I can make. And the only thing I have to do is subtract the $3 that I paid to get into this contract. So as the stock keeps going lower and lower and lower, I can make more and more money on my put option. So does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So as you can see, this is the hockey stick asymmetrical risk that most investors are attracted to when they first learn about options, because they think, oh, okay, if I think the stock's going to go down, instead of shorting the stock, right, I can buy a put option. So if the stock keeps going lower and lower and lower, I can make more and more money. But if I get this wrong, right, if let's say I just get the direction wrong and the stock goes higher, then guess what? The most I will lose is $3. Even if the stock goes to 1,000, I only lose $3. Because if I shorted the stock and the stock rises 10%, 20%, 30%, the more it rises, the more I lose. So that's why many times investors are attracted to this risk to reward ratio. But the problem here is the fact that when should you buy a put option? You can't just buy a put option on a stock that you think is going to go lower, because guess what? If the stock goes $2 lower, what happens? You actually lose money. And this is, again, one of the more counterintuitive parts about trading options, that if you don't take the time to learn the fundamentals and you buy a put option because you think the stock's going to go lower, And what you find out 2 months later is that the stock moved $2 lower, didn't move enough for you to make money. It did go in the direction that you expected to. It did go lower, but it just didn't go low enough that you still lost money. And that many times I find most investors will find very disheartening, is because you get the direction correct, but you lost money, and it's because you didn't really understand the fundamentals. So it's so important to learn these fundamentals, because not only do you have to believe the stock's going to move down, you have to believe it's going to move down by a certain amount. And that certain amount depends on how much the put options cost. So sometimes you're going to see that, you know, a put option might be, instead of $3, it might be $2, whoops, $2, and other times it might be $5 or $10 or $15. So the more the higher the more the put options cost, the more the stock needs to move before your strategy is profitable. So what you're going to find is that what you really want to do when you're buying a call or a put is, not only do you have to find a combination of stocks that you think is going to move higher or lower, you also have to find stocks where the call and put options are relatively cheap. Because whenever you're buying something, you want to buy low, sell high. So you want to buy a call or a put option that's as cheap as possible. And again, even that statement in itself is a bit of a misnomer, because you don't want to just buy a cheap put, a cheap call or a cheap put. You want to buy an option that's relatively cheap. And we don't have enough time or to get into what that actually means in this particular session. But again, this is why it's so important to take the time to learn these fundamentals and not just go out there and buy the cheapest possible option, because that in itself is another pitfall. So, but this is designed to give you a sense for just how do you start thinking about a call option and a put option, and how do you determine when do you want to buy a call, when do you want to buy a put, and understand that it's not just because I think a stock is going to go higher or lower. You have to also look at how much does that call cost, how much does that put cost, and that is another part that has to factor into your decision process as to whether you want to buy a call or buy a put. So lastly, what I want to do in the next couple of minutes before we wrap up, is I want to just walk you through very quickly of what it feels like to sell a call or sell a put, even though these are not necessarily strategies that you're going to deploy immediately, but it gives you a sense for how you can get a sense for selling a call and selling a put. Because on the opposite side of the transaction, what happens is when you sell a call option, what it looks like is it just looks like this. If you were the person who had the obligation to sell, so before we showed you that a call option looked like that, right? It looks like this. That's a call option. But what does a put option look like? A put option, I'm sorry, this is buying a call option. What is selling a call option? Selling a call option looks like this. It's basically the exact opposite, because you are on the opposite side of a transaction. So the red line is what it looks like to buy a call. To sell a call is the exact opposite. What happens is, for any price under $100, you keep your $3. And for anything above $100, you lose more and more money. Whatever the person gains on the buy side, you lose on the short side. Now, many investors will say, why the hell would I ever want to collect $3 and take on the risk of unlimited risks to the downside? The answer is because when you sell a call option, guess what? You make money if the stock goes lower, you make money if the stock stays the same, and you can even make money if the stock goes a little higher. It's a very high probability trade. Now, we don't have enough time to really get into the mechanics of selling calls and selling puts, but just to give you a sense for it, selling puts look like this. I'm sorry, buying puts look like this, and selling puts look like this. So the green line represents buying a put, the red line represents selling a put. They're just mirror images of each other, because remember, a contract has two sides, right? And whatever gains happens on one side, losses happen on the other side. So as an option seller, what happens when you sell a put is that you collect the $3, and wherever the put buyer is losing money, you're gaining that money. Wherever the put buyer is gaining money, you're losing that money. Again, the question for many investors is, why would I want to take on unlimited risk of the downside in exchange for just $3? And the answer is because, again, because here you make money if the stock stays the same, you make $3 if the stock goes higher, and you can even make a little bit of money if the stock goes lower. So you can really kind of have no real view on the markets, and maybe you think the stock's just going to stay where it is, move a little lower, move a little higher. It doesn't really matter. You'll make money in all those scenarios, and that's really another attractive way to utilize options. But those are some of the ways that you can utilize options in your portfolio. Now, I didn't have enough time to get through all of the details, but that's why the next session that we're going to do, I'm going to go into more detail of buying versus selling options so that you can really understand the difference between the two strategies. We're going to go through some better examples, some real concrete examples of some real stocks, and that's going to help you better understand these strategies. But today was just meant to give you a bit of a taste as far as what the options education is going to include for the month of August. So we do these sessions where for a whole month, we have a unified learning experience. It's not just you learn this, next week we're on to something else. Next week, we're just going to continue this education. And the month of August is all for beginner strategies. This is designed to give you a better understanding of a cohesive educational experience to help you really learn what you need to get started. And then what we do at the end of August is we do a live market trading session where we basically take everything we've learned during the month of August and we put it into a single session where we review what you learned and then go through some real examples so that you can see how we can apply what we've learned here using fictitious XYZ examples and see how you can apply it to the real markets. So with that, I just have 2 minutes here to try to show you some very quick examples. I do want to show you a real example before we open this up for Q&A. And this is the tool that you guys have access to either through a free 30-day trial, or some of you are already members. And if you don't know how to access this, I will show you here in a couple of minutes. But the platform itself is really designed from the ground up, OptionsPlay, to help you visually understand these types of strategies and analyze them and understand them before you actually execute them. So I'm going to use SPY, which is the S&P 500 ETF that I think most investors are familiar with. To buy 100 shares of that stock would cost you $33,000. To buy a call option, what we just explored here today, costs you $842. So remember, before we talked about stock XYZ trading at $100. Now we're talking about a stock that trades at $334. And now we're talking about a call option that costs, instead of $3, costs you $8.42. So $3 out of a $100 stock is 3% of the underlying stock price. How much is $8.42 out of $334.32? The answer is 2.5%. So the call option here is actually fairly inexpensive, meaning I have to believe that the S&P 500 is going to move up by about 2.5% in order for it to make sense for me to buy this call option. And I have to believe the stock's going to move up 2.5% before September 18th. So you can ask yourself, you can do your technical analysis, you can do whatever type of analysis you typically like to do, and ask yourself, do I think the S&P 500 will rally by 2.5% between now and September 18th? If the answer is yes, then you might want to buy that call option. If the answer is no, the answer is very clear. You should not buy that call option. And we have a P&L simulator here to help you better understand. Whoops, sorry. We have a P&L simulator here at the bottom of the screen to help you better understand these strategies and show you, well, if the stock goes up by a certain amount, how much money do I make? If the stock goes down by a certain amount, how much do I lose? So I always tell investors, before you look at how much money you can make, you should always first focus on how much money can I lose? Because if you're not comfortable with it, you should never get into the trade to begin with. So let's say I think the S&P 500 is going to go higher, so I'm considering buying this call. But I always want to say, what happens if I'm wrong? What happens if the S&P 500 pulls back 5%, maybe pulls back to 320? How much money am I actually risking, right? If I bought the stock, I'm risking $1,448. Ask yourself, is that the type of risk that you're comfortable with? If the answer is no, you should not buy 100 shares of SPY. If you bought this call option, you're risking $864. It is less money than if you bought the stock, but $864 is not a small amount of capital, right? So you could say to yourself, I'm not comfortable risking $864. If I'm wrong, $864 is a big portion of my account. If that's the case, you should not buy a call option. You should not look any further if $864 is not within your risk tolerance. Only if you are comfortable with potentially losing $864 if this trade goes south, do you want to consider looking at what are my potential gains if the trade does go in my favor? So as you can see here, even if the stock goes to $340, and remember, the all-time high in S&P is 339. So even if the S&P 500 gets back to 339, which is only $5 higher, guess what? You actually lose money on this call option. So again, this goes back to, it depends on not only do I have to be bullish on the stock, I have to be bullish by a certain amount. So 339 is not enough for this call option to be profitable. It actually has to move more. So you can actually use this price slider and you'll see that roughly around 342 is when this strategy starts to break even. So you have to ask yourself, do I think the S&P 500 is going to break above its February all-time highs? If you do, then you might want to buy the call option. If you don't, guess what? You should not buy that call option. And you can use the tool like OptionsPlay here to help you take any stock, whether you want to buy it on AT&T or any stock you want. Plug in the stock that you want. You can either select I'm bullish and see 3 bullish strategies and compare buying the stock to buying the call option, or select I'm bearish and compare shorting the stock to buying that put option that we talked about. And you can use this P&L simulator to see how much do I lose if I get this wrong? How much do I make if I get it right? And ask yourself, are those risk to reward ratios comfortable for me? And do I think that the outlook of the underlying stock is reasonable, right? So do I think AT&T is going to go down to, let's say, $28? If I do think that if it's going to happen, I make 100% return on my put option. That does look like a pretty good trade. So if I do think AT&T can get down to 28 bucks, then that's a put that I might buy. But if, let's say, the put option, if AT&T only goes down to $29, guess what? I make $0 profit. That's not something I want to do. That's not the type of trade that I want to enter, to risk $100 to make nothing, right? So use the tools that are available to you. This is completely, this is something that's available to everyone here, and I'll show you guys how to access this. But that shows, this is what I wanted to show you guys here today, is how you can utilize a tool like OptionsPlay to apply what I've taught you here today to real symbols that you might want to trade and look at and analyze buying a call option, buying a put option, understanding when they profit, when they loss, when there's a loss, and seeing which ones you're comfortable with and understanding the strategy, even if you're not ready to place those trades yourself. So with that, thank you so much, everyone, for taking the time out here this afternoon. I especially want to thank our members for supporting us and allowing us to continue doing this and educating and providing these resources to everyone. So if you don't have access to OptionsPlay, you can sign up for a free 30-day trial at OptionsPlay.com, which I just posted into the chat window. And for those of you that are currently on a free trial and thinking about joining us as a member, membership is just $75 a month or $500 a year. And I posted both links to everyone here in the chat window. So whether you want to sign up for a free trial at OptionsPlay.com, or if you want to become a member by using the link here on your screen. So with that, what I'll do is I'll open this up for Q&A. If you could please, there's a chat window and there's a Q&A window. If you have a question, please type them into the Q&A window. I will try to answer questions from the chat window, but preferably if you can put them into the Q&A window, it'll just be a little easier for me to manage all of those questions. So again, thank you so much for taking the time out here this afternoon. I really hope that you guys find this useful in better understanding option strategies, because like I said, once you truly understand the fundamentals, the world of options is yours. You can trade all types of crazy strategies and understand all types of strategies if you understand these fundamental building blocks. So let's go ahead and get started here with the questions. So Barry, your question about FLSY, I'm happy to comment on that, but if you don't mind, send me an email at info@optionsplay.com. I just don't want to use this education session to look at that. We do live market sessions where we do look at trades together, but that's not what we're here to do here today. Do you have an email I can reach you some questions before I subscribe? Yes, you can send us an email at info@optionsplay.com. I just posted that into the chat window. Oh, whoops, sorry. I think I posted all these links to myself. So that's the link to the chat window. I'm sorry, that's the link to our, sorry. That's our email address for those of you that want to email us any questions. Nikolai's asking, is this recorded? Yes, this is recorded. We will send you both the slides and the recordings, especially if you're a member, you're gonna get the recordings. Non-members, you're going to still receive the recording here until August 17th, and then those will only be available for members. Sunil is asking Tony, it would be great if you could cover managing complex options like condors and butterflies and ratios. So Sunil, I'm going to be doing that with Tom Sosnoff here on August 25th. For those of you that trade at Tasty or are familiar with Tom Sosnoff, if you like him, I'm going to have him back here August 25th. We're going to do a strategy session. We're going to do a lightning round strategy session. We're going to go over all different types of strategies. We're going to talk about rules for entering, strike prices, expiration dates, managing them. So Sunil, I hope that you're able to join us. We're going to cover all of those advanced strategies. Using options to buy stocks at a discount, you need to be able to afford 100 pieces of the stock or 100 shares, correct? Yes, that is correct. If you need to sell a cash secured put, you need to be able to buy 100 shares of it. What if I can't afford to pay for that many? Is there still a way to benefit from the option? The answer is no, but you can always find stocks that, there are lower price stocks. There are plenty of lower price stocks in the $20 to $30 range that you can sell cash secured puts on. ETFs in that particular range. A lot of the Vanguard ETFs are traded at a lower price, which allows you to sell a cash secured put on them. So it's just a matter of finding a stock that is lower priced if you can't afford 100 shares of, let's say, Apple. I was late, had connectivity issues. Is this webinar recorded? Yes, the slides and the webinar recording will be made available. In a debit vertical spread, in a call debit vertical spread, when the stock value goes up, what is the rule of thumb for both legs to spread up, roll up? So generally speaking, on a debit spread, once you reach about 75% gains on the debit spread, it's time to either close the position or roll the position up. So those are the general rules of thumb for that strategy. Whoops. Won't buying puts on a stock such as Apple potentially reduce the entire profit of the advance? Yes, so buying a put option costs money. And those are some of the things that we discussed during our hedging webinars to understand the challenges of buying put options for your portfolio. And that's why we always say to users that buying puts is not your only option to protect your portfolio. There are lots of other options that cost significantly less. You should only use put options as a last resort if you want to stay invested in the stock, but you want to protect a downside. Vincent is saying, what happens when a long call expires in the money? Will my broker exercise the call automatically? Vincent, generally speaking, that is the case. That is not necessarily the case for all brokerage firms. So I would always call your broker and ask them to clarify for you what the rules are around expiration. You're an excellent educator. Thank you so much. I really appreciate that. Tony, is there anywhere in the platform where we can see overpriced, underpriced options to buy or sell options? So Maura, we have if you look at our options platform, at the very bottom, there's a link that's called liquidity. If you click on the liquidity link, we have what's called an IV rank. IV rank gives you a sense for whether the options on a stock are cheap or expensive. And IV rank is built in a way that's relatively easy to read. It ranges from 0 to 100. 0 means that the options are relatively cheap. 100 means that the options are relatively expensive. This is comparing the options to itself over the past year. So IV rank is the typical indicator that we use to determine whether an option is cheap or expensive. So as you can see, SLV, 63%, very expensive. And for those of you that trade silver over the past few days, you'll know why. Options are very expensive in silver. Something like LQD, fixed income ETF, doesn't move a whole lot. Options are really cheap. So IV rank is one of the ways that we determine whether an option is cheap or expensive. Buy equals low volatility, sell equals high volatility. Bill, I mean, that is an overgeneralization of volatility. And if you really want to overgeneralize that, I would say the answer to your question is correct. but there are many, many exceptions to that. So I don't think that that's a hard and fast rule in my opinion. What is the difference between buying a call and selling a put? Don't they put you in the same position? Not at all. So if you think about it, buying a call looks like this. Whoops. Buying a call looks like this. Selling a put looks like that. Do those two look the same? I would say not at all. So this is something I'm actually going to cover on the next session. So join us next Thursday. We're going to be talking about buying versus selling options. So please make sure you join us for that. I'm going to be talking about specifically comparing buying a call and selling a put, because the two are really, really different from each other. As you can see, those graphs don't look anywhere the same. A call option gives you limited risk if you're wrong and unlimited reward if you're right. Selling a put gives you unlimited risk to the downside if you're wrong and limited gains if you are right. So the two, in my opinion, very, very different from each other. Very important that you understand those differences before you start trading option strategies. Thank you. This was very helpful. Looking forward to next week. Robert, thank you so much. Praveen, thank you so much. Great job, Tony. You make this look easy. It's really not that difficult. At least this part. I'm not saying all of options isn't difficult, but I'm saying this part of just learning what buying calls, buying puts, selling puts. It's basic arithmetic. But once you, and it takes a bit of time to wrap your head around it, but once you do, it's easy to understand, because all other more complex strategies is just adding basic arithmetic together. Jack, thank you. Very informative to learn. Thank you so much. How do we adjust the volatility in this example? Zahid, I mean, that is a more advanced topic. We will talk about that, but I think it's a little too much for this particular time of the educational session. Did the system pick the volatility? No, volatility is determined by the market. The market determines volatility. The implied volatility is determined by the price of the call and put option. Steve, Nissen, Brad, thank you so much. Jeff, thank you so much. Wayne is saying, Tony, I know a popular selling strategy is trade small and trade often. And I know that if we're buying options, we should adhere to 3% of the capital rule. But if we are buying, should we trade often? The trade small, trade often thing, in my opinion, has nothing to do with buying and selling. As long as you're trading small, you can buy and sell as frequently as the other. But the rule of thumb, like you said, 3%, I usually tell users, investors, never risk more than 1 to 2% of your entire portfolio on any one trade. So before, when I gave you that example of looking at SPY, where the risk here is 806, sorry, this was Uber. But before, when I showed you that the trade had $869 worth of risk, ask yourself, is $869 less than 2% of your entire portfolio? If the answer is yes, then go ahead and trade it. But from my perspective, buying and selling doesn't factor into trading often. You can trade often on both sides, as long as you keep it small. Kelvin is saying, my mentors state that buying stocks from the long call will lose extrinsic value. What does that mean? So a call option has, so the $3, so in the example here before, where I said that if you bought a call option for $3 and the stock after a month stays exactly the same and doesn't move, what happens? You lose $3. How do you actually lose those $3? It's because you paid $3 for extrinsic value. You paid for time value that is now worth nothing at expiration, because at expiration, if the stock stays the same, your call options are worth nothing. So what you've lost is $3 worth of time value. That's what you're really paying for when you're buying an option. You're paying for the ability for between now and the time that expires to be able to exercise this call. The less time there is between now and expiration, the less time value there is. So if, let's say I bought this call option on September 17th, the call option wouldn't cost me $3. It would have probably only cost me 50 cents or maybe $1, because guess what? The call option, I'm going to have a lot less time to potentially exercise my call. It's going to have less time value. So that's what he's referring to when he says that you will lose extrinsic value. Are there any stockbroker fees in addition to the $3 option contract price? So the great thing about trading options here in the United States these days is that fees are almost non-existent. You trade, most brokers still charge you about 65 cents a contract. So when you're, when I say $3, that's $3 times 100, which is 100 shares. So when you're talking about a $300 trade and you're paying 65 cents in fees, I would say 65 cents is fairly negligible for a $300 trade. Are you doing anything to prepare for pre-election and post-election to prepare your portfolio? So Gerard, as we get closer to election and we have a better sense for how markets may react to that, those are some of the things that we certainly will pay attention to. So please join us in our Tuesday and Friday morning Outlook sessions. You can join us at trade.optionsplay.com/weekly. So I just posted that link into the chat window. On the Tuesday and Friday morning Outlook sessions, this is where we talk macro. This is where we talk the markets and we talk about where we expect markets to go. And we will talk about the election as we get closer to that election and how we may want to position for ourselves. It's too early to tell. We still have more than 100 days to go to the election. So I certainly am not doing anything right now. As we get closer, we very well may. I have Ted, your question about SLV, I'm happy to answer that question, but please shoot me an email at info@optionsplay.com. Jason is saying, hi, Tony, if you let a bought stock or ETF expire in the money, do you automatically exercise? So Jason, again, most brokers would automatically exercise your call option, but it depends on your broker. So I'll always call your broker and ask them how they handle that. Does your membership show your own personal trades for us to follow? Andrew, we send out our trade ideas every single morning at 6 a.m. Those are available to you even if you're on a free trial so that you can check them out and test them out before you trade them. But in your membership, you will continue to receive that. Maura is saying, where can I already answer that? Arnaud is asking, how do you know when an option is too expensive? So again, IV rank is usually a good indication of whether options are cheap or expensive. So for example, SLV, 63%, that's telling me silver options are extremely expensive right now. How does the score determine the score number in the circle? Great question. So the score is designed to give you a sense for the risk to reward of an option. So as you can see, each option has a certain amount of red and a certain amount of green. And the inspiration for the OptionsPlay score actually came from poker players because an option strategy is very similar to a poker hand from the perspective of you have a potential reward, you have a potential risk, and you have a probability of success. So when a poker player, professional poker player, is sitting at a table, what they're really doing in their heads is crunching numbers. They're saying, how much can I potentially make if I am right, if I do win this hand? How much do I have at risk if I lose this hand? And what is my probability of winning that hand? And they're trying to calculate, do I have an edge? If they do, they'll usually place a bet. If they don't have an edge, that's when they choose to fold. So looking at an option strategy is no different from the same type of calculations that a poker player is to determine, do I have any edge in this particular trade? If you have an edge, that's when you have an options play score that's green. If you have no edge, you'll have an options play score that's yellow. And if the edge is going against you, you'll have an options play score that's red. Now, red doesn't mean that you can't make money on that trade. It just means that the probability and risk reward ratios are skewed slightly against you. And if in the red, and just because you have a score that's in the green doesn't mean that you're going to make money. It just means that this probability and risk reward are skewed a bit in your favor. So even though a poker player is constantly calculating whether or not the edge is in their favor, that doesn't guarantee them in any means that they're going to win or lose that hand. There are plenty of hands that they could calculate that the odds are against them, but they could still win, or if they think that the odds are in their favor, that they'll still lose, but just tells them whether or not there are odds or in their favor or against them. Tony, I know a popular selling strategy. Oh, I think I've answered that question already. How does the system decide what volatility the equity has? We don't determine what a volatility the equity has. The market does. The market tells us how much volatility the equity has. What is the probability of win using OptionsPlay platform? That's a great question, Sammy, because we're not telling you what to trade. That's up to you. This platform is designed to help you analyze, help you explore, help you make sure you understand your strategies, but it's up to you to decide what you want to trade. We're not telling you what to trade. How do you show IV and expected moves in OptionsPlay? So we have what's called the trading range simulator. So you can select any expiration date and we'll show you what the expected move for that expiration date is. So if you're looking at September expiration here for Uber, it's between 27 and 41. If it's December, it'll be 23 and 45. So you can use this trading range simulator, which is the fourth dot at the bottom of your screen, to get a sense for expected move. I bought a call option on TTGT out of the box. What do you think? Jay, I don't know anything about TTGT, so if you want to send me an email at info@optionsplay.com, I'm happy to take a look at it. But think about what I just taught you here today. Think about how much does that call option cost? Think about where do you think that stock's going to go? Ask yourself, do I think the stock's going to go that far? If the answer is yes, then maybe you made a great investment. If the answer is no, then I would consider getting out of that call option. Herb is asking, use your website, how would one determine if he should be bullish or bearish on a particular stock? Great question. So what we have for every single stock are multiple technical indicators. We have a 1 month and 6 month trend that gives you a sense for a short-term and long-term trend. And you can actually see at the bottom of your screen how long a stock has been in the bullish and bearish trend. In this particular case, Uber just turned bullish the last couple of days. It just turned bullish here. So it might be just starting a bullish trend, but it is a sideways market. So in a sideways market, these trend changes don't mean a whole lot unless you start breaking above some resistance levels. And we also have what's called a technical score. This is a relative strength indicator telling me that Uber is a relatively weak stock. So 1 month and 6 month trend turning bullish when the stock is relatively weak, not a particularly strong bullish candidate. Versus if, let's say, I take a stock like Apple, as you can see, 1 month and 6 month trend is bullish. It's been bullish for quite some time, which means that it is fairly late in the game. As you can see, it turned bullish here back in April. And notice how since April, it has been bullish the whole time since April 22nd. The only time we had any changes to this trend was just these couple of days when the 1 month trend turned neutral, and then both of them turned bullish again. And since then, the stock has continued to move higher. So that's one of the first indicators that I look at to get a sense for a directional view is the relative strength and the 1 month and 6 month trend. And you can even use your watch list. Your watch list is created based on the score and it's color coded based on the trend. So if you're breaking down in individual sectors, so let's say you're looking at materials and you want to know what are the strongest stocks and materials that have bullish trends, here, as I can see, FMC has a score of 7 and it's all green, telling you that's bullish. Sealed Air is also a score of 7 and it's bullish. ALB, same thing. FCX, SH Sherman-Williams, Newmont Corp. These are all the stocks that are bullish with a strong relative strength. So that is one way that you can break down and look at each individual sector. First of all, which sectors are strongest? Technology, healthcare, consumer discretionary are the strongest. Energy, financials, and industrials are the weakest, and they're color-coded so that you can see the trends. We've really built this in a way to allow you to quickly scan for opportunities in the market. Nick, would you be willing how one would put a trade to generate income in a bullish view? So Nick, something that we can talk about, but generally speaking, you would want to do is you would sell a call put credit spread here, something like this, where I'd sell maybe a 455, 425 vertical spread here. This is a credit spread. This is a more advanced strategies than what we're here to discuss here today, but I do have videos on our YouTube channel. So if you want to follow us, please go to youtube.com/optionsplay, which I just posted a link into the chat window. You can subscribe and we have videos on these types of strategies. Those are credit vertical spreads. You can find them on our playlist and you can watch those recordings if you're interested in learning about those strategies. How do we adjust volatility in your earlier example? So you can always adjust volatility using the volatility slider. So let's say you think the stock's going to make a move prior to expiration, you can make volatility assumptions and see how that changes the value of your call or put option. So you can use this as an implied volatility slider. Tony, I'm in a trial period. How's the alerts and notification boxes used in the portfolio section? I'm not seeing any posts there. So the alerts and notifications are designed to give you when there's an alert to take profit or stop loss. I don't see anything here at the moment. I will take a look at that and see if there's any of them that should fire off the alert and see if there's an issue there. I will take a look at that. Sometimes I see two listings for options with one listing noting an adjustment or adjustment. What does that mean? So usually when you have a stock split or a corporate action where a stock has a special dividend that was paid, or maybe a takeover, a merger, an acquisition. So if you look at T-Mobile, there are adjusted options because there are some pre the merger and some options that were listed post the merger. So those are the adjustments that are made. What is the difference between buying a call and selling a put? I think I discussed that, Bill. Will you be covering liquidity? So it is something that I do cover, but we have a liquidity ranking for each stock. And we rank stocks based on which ones are most liquid to which ones are least liquid. So the further down you go on the list, the less liquid it gets. But we also have a liquidity ranking. So as you can see, there are 228 symbols out of the full universe of 4,200 that we consider very, very liquid, which means that you can buy and sell almost instantaneously at the mid price with very little trouble getting filled at the mid price. When you get into the somewhat liquid names, that's when you have to probably move your orders a couple of cents off the midpoint in order to get filled. But generally speaking, you shouldn't have any trouble getting in and out with much ease, without a lot of trouble. But once you get beyond this 406 names, those are the names that you're going to have to work those orders. And generally speaking, if my preference is to not go off of this list. Any symbol that's not on this list, I will generally not trade options on because of the concerns around being able to get in and out very quickly. Dan is saying, great stuff. On selling cover calls, is FOMO, fear of missing out, a risk in selling calls? Also, what are your thoughts about when a stock rallies after you have sold the call and the price goes much higher than the strike you sold? Is that a loss? So it's not an actual loss. It's a lost opportunity, but it's not an actual loss because whatever you lose on the short call, you gain back on the underlying stock. So this is some of the fear of missing out sometimes, but arguably, there's plenty of other times where a stock rallies, you don't take profit and the stock falls later and you say, wow, I should have sold my stock at that higher price. So I think it works both ways. I'm certainly a fan of selling cover calls to take profits because that means that I can take the cash, roll it into another cash secured put on a stock that I purchased again. And you want to do that life cycle of buying buying stock at the lowest price possible using a cash secured put and then selling it at a higher price using a cover call. David, thank you so much. I'll see you next week. Nabil, if I join, how many recommendations I get per week? So we send a trade every single day, Monday through Friday, and it's either an opening or closing trade. So you'll average about 3 trades a week. Are your trades mostly credit or debit too? Yes, all of our trades are either debit or credit spreads. When will we be able to modify premiums on our trade to reflect my actual premium? Ronald, that is something we're working on. I expect to have that out in the next couple of months here. This is something that I'm actively working on. We've been working on a new portfolio look and feel. So what you're seeing here right now in terms of the portfolio, that's going to be enhanced. We've already started to build this out that allows you to look at details of your trade and see how you can adjust them. All of those are coming in the new portfolio tool that we're currently working on. Sanjay is asking, is it recommended during the stock is going up, debit call spread, upper leg roll up and holding the lower leg option? If you're asking if on a debit spread, should you roll up just one leg and not the lower leg? No, if you're rolling up a debit spread, you should roll up both legs. You should not roll up just one leg. Wait, low IV is cheap? Why do tasty traders say that they like high IV? Is it because they are sellers? Yes. So generally speaking, when you're thinking about tasty works, they will usually buy IV when it's really low and they'll sell IV when it's really high. Doesn't OptionsPlay show the difference? Sandra, I'm not sure what you mean by that. If you don't mind clarifying, I'm happy to answer that. Do you have trade recommendations? We send them out every single day at 6 a.m. So please make sure that you look at those emails. Sorry, between buying a call and selling a put. Sandra, also, if you don't mind clarifying. Does OptionsPlay show the difference between buying a call and selling a put? Yeah, absolutely. So you can look at buying a call and selling a put if you'd like. So those are the two. As you can see, they're very different, and you can use the P&L simulator and see how different they are. So one will make more and more money as the stock goes higher and higher. The other one's capped, and the other one will have limited losses. The other one will have big losses to the downside. So the two are very different from each other, but you can really compare any two strategies side by side. I have some positions that I'm long-term bullish in. Is there a trade that I put in, sell put to generate income as my positions continue to recover? So Nick, if you have some long-term positions in terms of the stock, the only way that you can generate income on it is to sell a covered call. But generally speaking, if you're down a whole lot on that trade, you're gonna find that it might be difficult to sell that covered call. Hi, Tony. 2 weeks ago, T-Mobile was traded diagonally. It will expire tomorrow. You're going to close them tomorrow or roll them. So the goal is to let this to August 7th, 110 calls to expire worthless and roll those out. That's the goal. Especially if T-Mobile's below 110 tomorrow, I'll likely roll those out to an August or maybe even early September weekly call option, maybe the 110, 115s, depending on where T-Mobile ends up on earnings. I haven't had a chance to take a look. Herb, thank you so much. Jack, at what percentage of gain do you try to buy back a call option to complete a transaction? Jack, if you're talking about, it really depends on what type of strategy you're talking about, so you're gonna have to clarify for me to answer that. Is implied volatility calculated continuously or daily? Implied volatility is calculated continuously. Only IV rank is calculated once a day. On your website, is there a way to determine if a stock is bullish or bearish? So that is something that we just discussed, the 1 month and 6 month trend and the technical score. I'm still having a problem understanding vertical credit spreads. Can you discuss this trade? Sell Shopify September 11th, 1035, 995. Put vertical at 1850. So Michael, what part of it do you want me to discuss? Because you've kind of laid it out here. And the best thing to do if you don't understand a strategy is to put it into OptionsPlay, because OptionsPlay will show it to you visually. P&L simulator will allow you to see how the trade moves. So if you're talking about a bullish short put spread for September 11th, you're selling the 1035, you're buying the 995, whoops, 995. Use the P&L simulator. I'm not sure what you want me to explain to you, but basically you have a break even at 1025. So if the stock's below 1025, you lose money. If the stock's above 1025, you make money. You have a max gain of 990. You have a max loss of 3,000. So you make 990 if it's above 1035. You lose 3,000 if it's below 995. That's if you trade it at the 1850 credit. Right now it's not at 1850. Right now it's at 990, and maybe those are after hour bid ask. So here's the mid price. Still not as high as the prices that you quoted, but roughly you get the sense here, Michael. If you have any further questions, send me an email at info@optionsplay.com. Dan is saying, I purchased a call debit spread for the first time. Am I correct that the max risk is a cost of the spread? You're absolutely correct. On the debit spread, the most you can lose is what you pay for the debit spread. Arnaud is saying, can you buy and sell an option at the same time at the same price? You're not going to be able to sell. I mean, what do you mean by buy and sell at the same time at the same price? Because if you bought and sold at the same price at the same time, first of all, you net zero and you'd have to pay a transaction cost. So you wouldn't make money on that trade. You would actually lose money. You'd lose the transaction cost. And you certainly wouldn't be able to buy it at the same price and make money on the trade. So no, Arnaud, that you wouldn't be able to do that, or else everyone would be doing that. Why wouldn't everyone be taking free money? Is it a good time to buy 20-year treasury bonds? That I'm presume TB means treasury bonds. So, you know, we are, Ellen, first of all, I think you should join us for our Tuesday and Friday morning Outlook sessions. That's where we discuss these macro themes. But I'm generally in the camp of long fixed income, meaning rates to zero, gold to infinity, as Carter Worth would say on CNBC. That is the general consensus here. You know, I have investments in LQD, TLT, GLD. Those are the plays that I'm using to play that long-term bullish view here for fixed income. Thank you so much for another excellent educational presentation and platform demonstration. You're very welcome. Please send the link for Friday at 5:30 session, or is it Monday evenings? No, they're Tuesday and Friday mornings at 9 a.m. Eastern. So trade.optionsplay.com/weekly is where you would go and get those. I cannot guess market moves. What strategy for this? I'm not sure what you mean by that. Richard, if you could clarify. Where can we get a listing of highly liquid stocks? They are bottom of your screen. So there's a liquidity link here at the very bottom. That's where you go for that list. Those are updated multiple times a day. How do I get a copy of this recording, Bruce? You just either have to be a member starting August 17th. Otherwise, for now, you're going to get that automatically as long as you're registered. How often do your options play scores win? The options play score doesn't tell you whether you're going to win or lose. The options play score tells you whether the trade gives you any type of edge or at all. Again, thinking like a poker player, you have a risk to reward ratio, you have a probability of profit. It's telling you whether that risk to reward ratio balanced by the probability of profit is either in your favor or against you. It's not telling you whether you're going to win or not, because whether you're going to win or not depends on the direction of the stock. The stock still, at the end of the day, has to go in the direction that you expect it to. If it goes against you, you're going to lose money. So the options play score doesn't care. It isn't a directional indicator. The 1 month and 6 month trends, the technical score, those are directional indicators. What is the meaning of the score on the trade ideas panel? What are the meaning of the scores in the trade ideas panel? This is the technical score. That's telling you whether the stock has strong relative strength or weak relative strength. Strong stocks are stocks that are outperforming the market. Weak stocks are stocks that are underperforming the market. Are your trade ideas mostly selling options? So we do a mixture of buying and selling. So if you look at our current portfolio, ConAgra is a bought. Disney was a bought, EA was a sell, eBay was a sell, IBB was a sell, T-Mobile was a time spread. So it's a combination of buying and selling. So we really do a combination. Please show how you get to the IV chart. John, we don't show an IV chart. Can you show some helping key features of your options play platform? My best suggestion to you is log on to our YouTube channel. We have a lot of videos on that. It's too much for me to be able to go through a full demo of the platform here right now. What happens if I close a credit spread before the expiration date? What happens to the collected premium? Well, you have to pay money to get out of your credit spread. So whatever you pay, you minus that from what you've collected, and that's your total profit or loss. Where on the site is a liquidity list? Again, it's here at the bottom of your screen is the liquidity list. How do we access those spreadsheets on IV? Those are, again, using the liquidity link at the bottom. What do you make of Disney trading higher after disastrous earnings? Do earnings plays still make sense? So, you know, this is one of the silly seasons that we're currently in. You know, earnings are coming in really, really weak for a lot of companies, and they're still jumping on it. You know, Disney, investors not really looking at revenues or profits, only looking at Disney Plus subscriptions. That was really the only positive thing that drove this market higher. At the end of the day, you can't control what markets respond to. You can only control your risk. And that's why it's so important that we use limited risk strategies like the one that we used on Disney, so that no matter what happens, we knew how much money we were going to risk and we were okay taking that risk. So that's the only thing you can control. You can't control anything else. Liquidity list, what are the different colors? The color is just color coding to tell you when IV rank and implied volatility is cheap or expensive. Red is cheap, red is expensive, green is cheap. Brad, when using a cash secured put to acquire a stock, will you be covering the specific steps to acquire a stock? So Brad, we will be covering that, and we actually have a recent video on YouTube. So I suggest that you go to our YouTube page where I have a recent video on that, where we talk about in detail selling a cash secured put. So I recommend that you do that. And if you can't find it, please send me an email at info@optionsplay.com. Is there a way I can filter option strategies for a given strategy? So we have a P&L simulator. You can actually select all different types of strategies from here, and you can click at the click of a mouse and be able to look at that on your screen. As a trial user, how do I access the site with the software? You just go to app.optionsplay.com. I will post a link into the chat window. app.optionsplay.com is how you access the platform. Is it recommended to avoid options that span an earnings announcement? Kevin, that depends on whether you're buying and selling. Generally speaking, if you're selling, we generally tell you to avoid earnings. If you're buying, that depends on whether you want to get exposure to that earnings. Maybe you want to get exposure to the earnings. I would suggest that if you're buying an option strategy, going into earnings, that is one of the ways that we utilize option strategies, but we also use spreads many times to trade earnings. What is a jaded lizard? Jaded lizard is an advanced strategy that is created by a couple of the girls on Tastyworks. I do recommend that if you want to learn more about the jaded lizard is to contact the Tasty Trade team. They can explain that to you, but I will have Tom Sosnoff on here on August 25th. We will discuss that strategy as well if you want to learn more. A couple of times when the recommendations came in, the premiums are different from what I see and when I try to place the trade. So this is one of the reasons why it's so important that you have access to a platform like OptionsPlay. Because if you just follow a signal provider or someone who's just telling you what trades they're making, chances are by the time you enter the order, markets may have moved. You want to make sure that you have the tools to be able to make adjustments to the strike prices, make adjustments to the trade, see if that trade is still a valid trade. That's why we have this OptionsPlay tool. If you're just following someone else blindly without knowing what you're trading, that is a recipe for disaster in the long run. So if you see a trade that we're putting out, you agree with the thesis, but maybe the market has moved and you still think it's a valid trade, log on to OptionsPlay. Place that trade yourself. Look at the strike prices. Maybe you want to adjust the strike prices up a couple of strikes or down a couple of strikes, depending on where the market has moved, and then find a trade that's suitable for the time that you are executing that trade. So that's why I think it's so important to have access to a tool that gives you ideas like the ideas that we send out, but more importantly, a tool that allows you to analyze those ideas so that you can make informed decisions as to whether you agree with that idea before you place it. Sometimes you might just disagree with our outright thesis, right? So we might say that we're bullish on Microsoft. You might say, I'm bearish on Microsoft. Guess what? If you're bearish, you shouldn't trade our bullish idea. So use the platform to analyze these trades, adjust them if you need to before you go ahead and place that trade. T-Mobile is up after hours. Are you going to send us how to roll it up? Ellen, I will send an update on this, but depending on where T-Mobile is, I'll take a look. Let's see. It's up to 114. Wow. So we will definitely send a report tomorrow as far as an adjustment here for T-Mobile. Do members get to see the track record or picks over the last year? Yes, every single day we send you an email at 6 a.m. At the bottom of that email, there's a link to our performance record so you can log in and take a look. Ellen, I sold SQ calls last month and it's gone up so much. How do I repair my call? Ellen, there's no such thing as a repair on a short call. You have to be, when you sell a call option, you need to understand what your risk is. You need to know what that risk is, and you need to know when to get out if you are not comfortable with that risk. There's no magic formula that allows you to just repair a short call. So my suggestion to you is if you've already exceeded your risk tolerance, get out of the trade. That's the best advice I can give to you. Many times I see investors try to quote unquote repair a trade and actually take on more risk and potentially open themselves for even more exposure. That is the recipe for disaster, unfortunately. So Ellen, please, next time you place a trade, first understand what is your max risk. Ask yourself, am I comfortable with that max risk? If you're not comfortable with it, don't get into the trade to begin with. But if you find yourself already in that position, the best thing you can do is get yourself out of that position altogether. Sammy, I sold a $80 call for win. I sold an $80 call for win for $8.21 and the stock went up $7. How do you know when to stay or close a trade? Sammy, you know, you're close to expiration, you're approaching expiration. So my suggestion to you is, generally speaking, is to roll those calls higher when you sold an $80 call for win. Well, you're still below the strike price, so you're okay. I would certainly think about closing that call option as you get closer to expiration, but chances are you might still have that close below 80 before expiration. All of our Tuesday and Friday market outlook sessions are recorded and it's available to all members. Louise, thank you for the presentation. I'd like to learn more about leap option strategies. That's something you teach. Luis, yes. So if you go to our YouTube channel, I actually have videos on leap options. Of the suggested trade ideas, do you have any testing to see how well they play out? I'm not sure what do you mean by do you have any testing to see how well they play out? James, if you could clarify, can you still be bullish on a strong stock if the whole market is on the verge of crashing? Sure. I mean, obviously, if you think the whole market is on the verge of crashing, you probably would want to limit the long exposure you have in underlying stocks. When you get the trade recommendations, can we play around with the range to help manage our risks? You can certainly play around. That's the whole point of this platform, is so that you can play around with our ideas. Think of our ideas as just ideas. They're not, you know, you have to do this or bust, you know. They're just ideas, right? We're telling you a fundamental and technical thesis of a trade. We're telling you how we're playing that trade. But chances are by the time you enter the trade, maybe you have a different time horizon. Maybe you disagree with our trade. Make adjustments, play around with it. That's why we created OptionsPlay. That's what we call it, Options Play, because options, there are so many options. Play around with them, see what's available. Perhaps we didn't find the best possible opportunity. At the end of the day, there are billions of combinations of how you can utilize options. Perhaps you can find a better one. And this really comes down to understanding the fundamentals. If you understand the fundamentals and you know how to build option strategies, perhaps you might even find a better one than we do. We're not saying that we found the best possible combination. We're saying that based on our thesis and our views, this is how we would express those views using option markets, but you might have slightly different views and you might express them differently. And the value of the tools that we provide is the ability to do that work yourself and see for yourself what's the best strategy. This is very different than most other strategies or most other places that just tell you follow the leader, do exactly what we do. We don't believe in that, because I don't know how many of you have tried that model. I mean, I've seen so many traders that say, I've tried those things, it worked for a while until it didn't. And the reason for that is because you didn't have any control over what you were doing. You were just following what someone else was doing, and that person might have a different view than you, and you don't really have a way to look at that view and adjust that view and change that view based on your own views. And that's why we created OptionsPlay. Is there a way to filter trades with the score of over 100? Mike, just because an option has an edge doesn't mean that you should trade it, right? So just because, you know, this call option here is really cheap on Apple doesn't mean that you should buy calls on Apple, because it still requires the Apple to make a significant move to the upside before those calls will make you any money. So just because a call option is cheap is not a good reason to buy them. You can find, even if the call options are $2, it doesn't make sense to buy if you think the stock's going to go lower. That's why we don't scan for just where is there an edge. You need to first have a directional view before you can look for an edge to see if because you have to first believe that Apple's going to go higher. You have to then look at call options that make sense for your outlook, meaning your time frame, your strike prices. Then you want to see, do those expirations and strike prices give me a bit of an edge, or maybe maybe there is no edge, maybe the edge is against me. At that point, do you factor into it? Because the edge part is a very small portion of actual gains. You know, when you have an edge, it just means that you might actually make an extra 10, 15 bucks off of the trade. If you don't have an edge, you might lose 10, 15 bucks on the trade, but in itself is not a good enough reason to buy a call option. James, you're very welcome. Thank you so much. Do you have a video teaching the platform? Yes, we do. So please follow us here on YouTube. Ted, thank you so much. I really appreciate it. I want to learn how to pick strike prices. Nicola, I have a whole video on YouTube just on that alone. Optimal expiration dates and strike prices is the name of it. So please take a look at that. How about a class on trading options on E-mini futures? Tulio, I'm actually talking to the small exchange. On Monday, again, I spoke to them a couple of weeks ago. They have a new futures product and a new futures exchange that's launching that I think is really suitable for retail. You know, I used to be a futures trader. That's how I learned how to trade, is on Thinkorswim with Tom Sosnoff. So I have a you know, a soft spot in my heart for teaching futures trading. I actually did many years of futures education. So I'm really looking forward to potentially doing some more futures education here for the next couple of months. But after I have some conversation with the small exchange, understand their products a little bit more. I haven't traded them myself, so I'd like to you know, take a look at them before I start teaching them. But it's something that we plan on adding here towards the end of this year. Tulio, thank you so much. Jarrett, for some stocks that have weeklies on platforms like Thinkorswim, I haven't seen them on OptionsPlay. Are these available? Jarrett, every single option you see on Thinkorswim, you can find on OptionsPlay. There's no option that you're going to find on Thinkorswim that you won't be able to find here on OptionsPlay. So if you go to the expiration dropdown, all the weeklies, all the monthlies, all the quarterlies, all the leaps, they're all available here. What's the small exchange? It's a new futures exchange. They're launching new futures products that are geared for retail. They're smaller size, and they are all consistent in terms of contract sizing, so that you don't have to be confused about, you know, how certain contracts are 62,500 and other ones are 12,500. Futures contracts inherently are quite I would say, confusing. So they've kind of created these really nicely packaged futures products that are much smaller, suitable for retail. So it's a new exchange that just launched here on June 1st. If you exercise a call that's in the money, do you need enough cash to buy it? Leon, yes, you do. You need to have the cash to buy 100 shares. If you exercise a put that's in the money, do you need to sell the stock first? No, not necessarily, but you need to have the margin to hold that stock, to hold that short position in that stock. Is a small exchange only on Tasty? No, the small exchange is just an exchange. It's going to be available on a lot of brokers. So Interactive Brokers, Tasty, and a few other brokerage firms right now currently offer it. I think E-Trade is looking at it. So quite a few brokerage firms are currently in the process of vetting that exchange. Can you explain the Disney? Can you show an example of how that worked for you? So Joseph, you know, the Disney trade was a speculative trade. We were betting that Disney would decline on earnings. The answer, the result of it is it didn't work out. But the reason that we used that put spread is because in that particular instance, I was risking only about 3% of the stock price to take a bearish bet going into earnings. Because it didn't work out, I lost 3% of the underlying stock price. That was a risk that I was willing to take. And not all risks that you take work out, but you want to make sure that you understand what those risks are and you're comfortable with those risks before you place that trade. That's the most important thing, because you cannot control where the markets go, but you can control your risk. Martha, I am a doctor in education. You're absolutely one of the greatest educators. Thank you so much. I really appreciate that, Martha. Joseph, you're very welcome. So thank you so much, everyone. I hope you guys have learned something here today, especially for those of you that are new to options trading. I know that options trading is many times confusing. It can be difficult. So I want to make sure that you guys have access to the best possible education to learn the fundamentals, and then more importantly, have access to the tools to be able to actually implement and explore what you've learned here today. Because many times you might hear someone educate you on options trading, but when you log into your platform, it looks completely different. You don't know what you're looking at, and it's very different from what you learned. That's why we teach on OptionsPlay, so that you can log into the platform afterwards, you can see how it works and explore for yourself. So thank you so much. I hope you guys all have a great evening. We'll send out the recordings here to everyone once we finish processing them with the slides, and we'll see you guys next Thursday. And please join us tomorrow morning at 9 a.m. for our next market outlook session, for those of you that want to learn more about where you think markets are headed next. So see you in the morning. Good night.